Welcome to our discussion on the multinational cost of capital, a crucial concept for understanding global finance. The multinational cost of capital is the return a global corporation must earn to satisfy investors and lenders across multiple countries. Unlike domestic firms, MNCs face unique factors like currency risk, political instability, and varying global interest rates. Understanding this concept is vital for making informed investment and financing decisions on a global scale. The cost of capital directly impacts investment decisions, such as whether to open a new subsidiary abroad. It also guides financing choices, like deciding whether to borrow in the US, Europe, or Asia. Furthermore, it's crucial for valuation, helping estimate firm value and shareholder wealth. Finally, it plays a key role in risk management, assessing how global risks affect required returns. Several international forces significantly shape an MNC's cost of capital. Exchange rate risk means future cash flows in foreign currencies may lose value when converted to dollars. Political risk stemming from instability or policy changes raises uncertainty for investments. Global interest rate differences mean countries have varying borrowing costs. For instance, Japan has historically offered very low rates. Inflation differences also play a role, as high inflation countries require higher nominal returns to compensate investors. Different corporate tax rates across countries directly impact after-tax returns. Market segmentation, where some financial markets restrict foreign participation, can also affect capital access. For example, a U.S. firm borrowing in Switzerland might pay lower interest rates but faces exchange rate risk if the Swiss franc appreciates. MNCs can sometimes enjoy a lower cost of capital due to their global reach. They can access multiple capital markets, issuing bonds or equity in diverse regions like the U.S., Europe, or Asia. Diversifying operations across different regions helps reduce overall risk. A strong global brand reputation often leads to stronger credit ratings, making borrowing cheaper. They can also borrow in low-rate countries, such as Japan, where interest rates might be as low as 1 to 2%. For instance, Coca-Cola frequently issues bonds in Switzerland to benefit from its low borrowing costs. However, operating globally also introduces additional risks that can raise the cost of capital. Exchange rate volatility can cause earnings to fall when converted into USD. Regulatory complexity means compliance requirements differ significantly across countries. Political instability, like in Argentina, can require higher expected returns for projects. Global crises, such as worldwide recessions or supply chain disruptions, increase investor risk. Global tax environments significantly influence capital costs by affecting the after-tax return required by investors. Corporate tax rates vary widely, with Ireland at 12.5%, the US at 21%, and France at 25%. Tax treaties reduce double taxation, while tax incentives like holidays or subsidies attract investment. Transfer pricing rules also impact where profits are recorded, as seen with companies like Apple using Ireland's low tax rates. A practical, qualitative approach to estimating the cost of capital involves identifying global risks and determining the cheapest financing options. It also includes evaluating how diversified revenue sources reduce risk and considering various tax and regulatory environments. For example, a U.S. firm operating in Germany and Singapore might have more stable earnings than a domestic-only firm. This reduces required investor returns, showcasing the benefits of international diversification. In conclusion, understanding the multinational cost of capital is essential for students and professionals navigating the complexities of global finance. It empowers better decision-making in investment, financing, valuation, and risk management for multinational corporations.